So lots and lots of things which we talked about. We of course picked up several examples. We also picked up questions which were there in the examination. Now I'm going to talk about some more concepts that when you have to apply fair value in practice, right? What more we need to think about, which is called highest and best use, right? Which is in use or in exchange, right? In use when I'm going to use it myself or I'm going to sell it, right? Which is fair value less cost to sell. So and again, when you talk about in use or in exchange, you look at whether it is legally permissible, whether it is physically in a way possible, financially, whether you have the ability to do it. All of that is what in a way you look at. So, and this is more relevant in the context of the fair valuation of a non-financial asset or a liability, right? So a fair value measurement of a non-financial asset takes into account a market participant ability to generate economic benefit by using the asset in highest and best use. Highest and best use means what? Highest and best use means what? In use or in exchange. So if I were to use it myself, how much I'm going to generate the benefit, or if I have to sell it, right? How much I'm going to generate, right? In use or in exchange. Highest and best use, consider a use that is legally permissible, physically possible, right? And financially feasible. So it has to be physically possible, legally permissible, and financially feasible. Okay. The current use is presumed to be highest and best use unless market and other factors suggest otherwise, is always considered when determining the fair value, even if the entity intends a different use. Let's try and understand this. With the, so again, remember, highest and best use is in use or in exchange, and it has to be in the context of it is physically possible, legally permissible, and financially it is feasible. And it is presumed that if I'm a rational investor, if I'm an economic investor, I'm going to use an asset for the best possible use. If I can't generate return, if I believe that I can make more by selling, then I want to sell it, right, and exit out of that asset, right? Or if I believe, no, I can generate more return by using it, then I want to continue to generate more return, right? You got to make a very dispassionate, in a way, investment decisions. That's the whole objective, or let's say the underlying principles in the standard. So let's take this example. A land which is intended for business purposes has been bought by X Limited. A land which is intended for business purposes has been bought by X Limited. However, the company now wants to sell this land at its fair value. Awesome. Okay. In such scenario, one has to evaluate all possible use of this land before concluding its fair value, right? Land could be used to make a commercial place, or could be housing society, or could be as a parking shed, or whatever that's legally permissible, financially feasible, and physically possible. You got to look at all three factors, right, to assess, what's the possibilities here, and then you should determine the fair value. Okay. Then we're going to talk about valuation, right? How do you look at the valuation principles? Should be based on in combination with other assets or independent of other assets, right? At standalone or in combination. So again, you're going to do this based on marketplace participants. How do people going to value this asset? How do I maximize the value? Okay. Can I maximize the value by selling it on a standalone basis, or I maximize the value by selling in combination with others? How do the counterparty is going to look at it? That's how you again try and maximize in use, in exchange, in combination, all of the scenarios, which are again keeping in mind what is physically possible, legally permissible, and financially feasible. All right, all of that. So standard requires to use best used value if such financial asset, non-financial asset, is used in combination, right, with some or other asset, and it is demonstrated that such combination is widely used by other market participants also in order to find best use for such non-financial asset. Okay. How do you determine fair value of a liability or equity instrument? So again, you ask the question, is there a quoted price? If the answer to that is yes, there is a quoted price, then use the quoted price. If the answer to that is no, there is no quoted price, then is an identical item held by another party, right, as an asset? Answer to that is yes, then use that comparable price. Okay. Now, if the answer to that is no, then use the fair value techniques, the valuation technique, okay, fair valuation techniques. And we're going to talk about fair valuation techniques. But before we get to the fair valuation techniques, we're also going to talk about another concept on offsetting positions, right, in market risk or counterparty risk, right? We're going to talk about this offset. So essentially what we're trying to say that or this principle suggests that if there are assets and liabilities, multiple assets, multiple liabilities, and they're offsetting each other, and that's how marketplace participants look at it, then you are also supposed to consider those scenarios while you are assessing fair value. It's a very objective assessment. So, and this assessment is driven by how market forces are going to drive fair value, and also with an objective that how do I maximize the value, okay? And looking at from a market forces perspective. All right. So and then the principles, right, how these assets and liabilities are being managed by an entity would be affected by its market risk, which is interest rate risk, the currency risk, the price risk, exchange risk, right, and credit risk. So four types of financial risk, right, which is what you know. And then there could be n numbers of non-financial risk, right? Whether it's going to rain today or not, that's a non-financial risk, right? Whether the interest rate will go up or down, that's an interest rate risk. Whether the currency exchange will change or not, that's an exchange rate risk, right? Whether the prices will go up or down or not, that's a price risk. Okay, so you look at the financial risk and whether you're going to default or not, that's a credit risk. So you're going to look at the price, you're going to look at a financial risk and the non-financial risk. Okay, from that perspective, how these assets or liabilities are being managed. Certain contracts of derivatives which are being netted with all existing open position from same counterparty. That's how you manage your credit risk, for example. Okay, so measure the fair value of the group of financial assets and financial liabilities consistently with how market participant would price the net risk exposure at the measurement date. Remember, we are more driven by marketplace participants, okay, more driven by your risk measurement process, right? For us to determine that should I value on a standalone basis, should I value after factoring in the offsetting risks which I have under these arrangements. Okay, applying fair value, again from a market risk or counterparty risk perspective, exception is allowed in cases the other marketplace participants also manages this on a net basis, right? There has to be information available, which is what I talked about, and the unit of account also would be considered as net, right, on a net basis, and should be same while combining those asset or liability. Interest rate risk cannot be netted with a commodity price risk. So you can't risk one type of financial risk with another type of financial risk. That's not permitted, right? That's not permitted. So you need to be careful here. Now, also the duration also to be identical, because something which you price it based on 1 month versus 2 months, that could be very, very different risk and reward. There could be events which are happening in that period. There could be anything, right? Hundreds and zillions of things. So again, these are rules which are very, very specific and to be applied in a specific context and to be careful. And there is, of course, there are elements of judgments which are also involved at times. So an interest rate swap of a longer period will only be allowed to value at net basis up to the duration of financial instrument of the same duration. Okay. So quickly to recap what we talked about, applying the fair value in practice. When you look at a non-financial assets, you look at highest and best use, in use or in exchange. In the fair value in combination with other assets or at standalone basis. Liabilities, again, use quoted price, use fair value of identical value if quoted prices are not available or use the valuation techniques. And we also then talks about the offsetting position in market risk or counterparty risk. Again, you do it with caution, you do it depending upon how the market participants look at it, also making sure that the risks are identical and are offsetting and are also being looked at from that lens from marketplace participant. Okay, so now we are going to talk about recognition and valuation technique. Okay, it means how do you value and how do you apply some of these valuation techniques, which are, I said, right, there are three types of valuation techniques, which is your income approach, the market approach, or the cost approach. And also then we said that how do you categorize those fair value evidence, which is level 1, level 2, and level 3. So that's what we will try and understand. So, and also how do you, when you say fair value, right, fair value is an exit price received to sell an asset or paid to transfer a liability in an orderly transaction between marketplace participant at the measurement date, right? And the number of principles is what we talked about. Okay, so you got to apply all of that when you think about fair value at initial recognition. There are a number of standards where we look at fair value at initial recognition. And ordinarily the transaction price represents the fair value. All right, now if you have evidence otherwise, then you take something else as the fair value. But otherwise, in 99.9% of the cases, in my experience, is the transaction price which is the fair value, unless there's something hanky-panky going on, unless there is some structure was being there, and hence this is not to be considered as fair value. And one of the common example, or not so common, I would say a rare example, is when, let's say, you entered into doing a transaction where you ended up buying something from a counterparty which ended up selling this under stress. Okay, under stress, that means you can actually get a big bargain, right? And then there are not too many sellers under stress. Okay, so it's not that everybody is under stress, right? If everybody is under stress, that means that's the state of the market. That was the situation in pandemic, right? Or in 2008 credit crisis, or in a way when the markets are depressed. Okay, but it is not about markets being depressed, it's about a counterparty being depressed, and you were able to take advantage of that situation and we were able to bargain a good price, right? But then that may not represent fair value. Okay, and hence the transaction price then may not represent fair value. Okay, but you've got to exercise this with caution, this exception. So when an asset is acquired or liability is assumed in an exchange transaction for that asset or liability, the transaction price is the price paid to acquire the asset or receipt to assume the liability. Transaction price, right? The transaction price, right? In many cases, the transaction price will equal fair value. Okay, which is that might be the case when the transaction date, the transaction to buy an asset take place in the market in which the asset would be sold. For example, the transaction price might not represent fair value if any of the following condition exist. The transaction is between related parties, right? It may be used as an input, but it may not, let's say, represent fair value. The transaction takes place under duress, or the seller is forced to accept the price in the transaction. So I think that's something which to look at. The unit of account represented by the transaction price is different from the unit of account for the asset or liability, which is measured at fair value, right? Or the market in which the transaction takes place is different from the principal market. So there are a number of factors which you need to consider before you were to conclude that the transaction price do not represent fair value, right? More often than not, in fact, more likely in all scenarios, that you will end up concluding that the transaction price do represent fair value, unless it's a related party transaction, selling it under duress, it's in some part of the world which is not a principal market, or being sold in volumes or quantity which does not represent the unit of account. So I think that way you try and figure out what's the transaction price and what's the fair value. Okay, and then let's talk about the valuation techniques. That I told you there are three types of valuation techniques, right? And it's a market approach or a cost approach or an income approach. Okay, and you apply a valuation technique to a specific scenario, right, which represent that asset or liability to be applied. There is no right or wrong answer here, but you got to apply your judgment. And many times we also see a combination of these measurement techniques are being applied to determine the fair value. Okay, and each of these can give you a different answer, and that's why the assumptions are important, the disclosures are important, and that's why they are being called as level 3 valuations. Okay, the least reliable form of fair value. Okay, when you have to apply a fair valuation technique, they are the most unreliable, but that's what the standard permits you to do, provided you do sufficient amount of disclosure, you do enough testing on the assumptions, and you are comfortable with this, that these assumptions are robust, and you make disclosures, and that's the basis at which you have determined the fair value. So what's a market approach? A market approach is a valuation technique that uses prices and other relevant information generated by market transaction involving identical or comparable asset, right? Or a group of assets and liabilities such as business. Okay. A very simple example is a market multiple or a EBITDA multiple in the similar industry, which is what if you, which is P multiple, price earning ratio, is the most common in a way factor which is being used to determine fair value. That is called market approach. So let's say if you have a business, let's say you're an auto business making auto components, you make, let's say, 50 crores of profit, you're an unlisted business, you see there's another company which is listed in the similar space, auto component. Now they are being traded at, let's say, 10 times the profit. That means the business value is 500 crores, 50 crores profit you make. If they value 10 times the price earning, that is your value. That is a way of determining fair value. Okay, which is comparable transaction, market approach, right? A price earning ratio. One of the ways, but there are, of course, there are a number of such companies that are out there. So you want to take a basket of such companies and then try and say what's an average market multiple, and that you may want to apply. Then you may want to make some adjustment. Look, my profile is different. I am certain I deal with premium customer, or my margins are better, so I may get a better valuation, this and that. So there could be certain assumptions, right, which goes into some of these determination. Okay, there could be matrix pricing, right? That's also is possible. So there could be matrix pricing as well. So compare with similar benchmark securities, including credit ratings, often used for equity securities, which have quoted price, real estate, when comparable transactions and prices are available, investment properties, land and buildings, right? The multiple of such assets are being valued using market approach. Example, P Limited is in a specialized industry. It does not have any security which is quoted in an active market. To obtain its enterprise value, P Limited is, however, using its price to earning ratio with certain adjustment relevant to the business. For example, there are some specific restriction to use certain assets for some specific period, being in a specialized industry. So that's how you apply a market approach to determine your fair value. Now let's talk about the income approach. Again, we also see a lot of companies using income approach to determine fair value, and most commonly used income approach is the discounted cash flow approach. Okay, DCF is what is being called, and I'm sure a lot of you are familiar about DCF. So the income approach converts the future amount, right, the cash flows or income and expense, to a single current amount, right? That's the discounted amount. When the income approach is used, the fair value measurement reflects current market expectation about those future amounts. So when you do income approach, right, you don't consider significant capex, right, or significant increase in capacity for that existing. You value the existing asset for their existing capability, right, existing with some, of course, maintenance and so on and so forth. The income approach is applied using the discounted cash flow, which requires estimating the future cash flow, estimating the terminal value if appropriate, discounting those amounts to present value at a rate of return that consider the relevant risk of the cash flows. So you look at again those debt equity components and things like that. Typical use to measure value of businesses, right, for computing an IRR, financial instrument which are not traded, or for liabilities, or for intangible assets, right? So again, when you look at an income approach, there are different valuation techniques. Present value technique, which is a discounted cash flow. There could be option pricing model, like a Black-Scholes option pricing model, or it could be a multi-period excess earning method, right, which is being used to fair value some intangibles like customer relationships. So I think there are valuation techniques, and within also valuation techniques, there are multiple models, which are being allowed, which are being there to be used, right, for companies. And that's why the disclosures, the assumptions, the estimates, the comparability, right, all of that, it becomes extremely, and consistency in using of those assumptions, it becomes extremely important. So when you look at an example, company AV Limited has estimated its next year earnings based on certain probabilities, which can be mentioned below, which is 20%, 40%, 40. And my possible cash flows are this much. So I'm going to apply them. I get to a total expected cash flow of 41,000. I'm going to look at a risk-free rate of 6%. I'm going to discount them for 1 year. That gives me my discounted cash flow is 38,679 for 1 year. Okay, for 1 year. That's just one kind of example. There could be multiple inputs to the valuation technique, and then there's a cost approach is also referred, current replacement cost, right? So I think we talked about the market approach, we talked about the income approach, and then we're talking about the cost approach, right? We're talking about the cost approach. Okay, is the current replacement cost. This is commonly actually being used in heavy industries, right, which are asset heavy industry or capex heavy industry, so to say. So when you look at, when analysts are trying to value a steel plant, or valuation of company, a steel company or a cement company, and they say, oh, look, the price of the stock is so much, and then they try and say, okay, if you were to set up a steel plant today, this is what it's going to cost you. So that's the enterprise value. Then how much is the debt on the balance sheet of this company? Then this is the equity value should be, right, of this company. So that's how you try and value some of the asset heavy businesses, okay, which may not represent, let's say, in the earnings, but what does that mean? The potential to generate earnings is there, because these are cyclical businesses, right? These are cyclical business. So for some period the prices are depressed, for some period the prices are sky high. So that's how you try and fair value some of these, right? Current replacement cost. So this method describes how much cost is required to replace the existing asset liability in order to make it in a working condition. All related cost will also be at fair value. Replacement cost, asset liability, for which we need to find fair value, like property, plant and equipment, right? For example, if company A has to determine fair value of its factory machinery, using this approach, fair value would be the cost that would be incurred by company A to replace the machinery on the date of valuation, right? So valuation techniques used to measure fair value shall maximize the use of observable inputs, right? Observable inputs, right? And minimize the use of what is being called unobservable inputs. Observable inputs versus unobservable inputs. So you try to maximize the use of observable, which are evident in the marketplace, versus entity specific inputs, which are called unobservable inputs. It has widely been mentioned that observable input should be used to evaluate fair value of an asset or liability. We should minimize using any unobservable inputs. So standard describes the below instances where observable inputs are being used in case of certain financial instrument: exchange rate, the closing prices, the readily available, the dealer market, the bid and ask, the brokered market, buy and sell, order matching, commercial and residential market. So in all these cases, is what you try to use the observable inputs. All right. So let's just try and recap what we talked about. We talked about the valuation techniques, right? These are appropriate in the circumstances for which sufficient data are available to measure fair value. When you don't have quoted price, then I have to apply valuation techniques, right? And we talked about what the valuation techniques: market approach, income approach, and cost approach. Okay, maximize the use of relevant observable inputs and minimize the use of unobservable inputs. What are my valuation techniques? Market approach, cost approach, and income approach. And then we saw what are the different types of assets for which you try and value these methods. There could be a combination of methods, and those assumptions you need to disclose, and you got to again be consistent, right? And maximize the use of observable, minimize the use of unobservable inputs. All right. So now we are going to talk about fair value hierarchy. Okay, fair value hierarchy. So what's the fair value hierarchy? Fair value hierarchy is in a way trying to place reliance on the quality of fair value assumptions being used, or the quality of fair value from a measurement perspective, what you've done, so that you can provide information to the reader that even though you applied fair value, the level of evidence, the quality of that is level 1, level 2, or level 3. Level 1 is P and Q, which is price into quantity. Level 2 is based on observable inputs, comparable prices. Level 3 is, that's where the grayness is, that's where the dark zone is, right? Is where there are lots of assumptions, there are many more estimate. That is level 3, and there are more disclosures required for level 3. Okay, so level 1 is quoted price, in active market for identical assets or liabilities that the entity can access at the measurement date. A simple example is share prices, right? They're quoted on a stock exchange. That's for listed securities. Level 2, in a way. So let's say if the commodities, they are quoted at 1 unit, but if you want to value 100 units, and you want to sell it 100 units, that's become then comparable prices, right? Inputs other than quoted prices within level 1 that are observable for the asset or liability, either directly or indirectly. Now, level 3 is unobservable input for the asset or liability. Example: quoted prices, interest rates and yield curves, and growth rate applied to historical cash flows. That is what is level 3. Unobservable inputs. Level 3 is unobservable inputs. Okay. So level 1 is holding investment, which is quoted in BSE, India, and NYSE, USA. However, significant activities are being done at BSE only. The fair value of the investment would be the transaction price or the quoted price at BSE, which is the principal market. No adjustment. Level 2, receive fixed, pay variable interest rate swap based on a yield curve denominated in a foreign currency. Okay. It requires rate of swap which is of 11 years. However, normally the rates are available only for maximum period of 10 years. So you try and extrapolate the 10 year to 11 years. Okay, that is what comparable prices based on observable inputs. That is what is level 2. You look at level 3, right? Example of level 3 is an interest rate swap, an adjustment to a mid-market consensus non-binding price for the swap is being developed using data that are not directly observable and cannot otherwise be corroborated by observable market data. This could be level 3 fair value. Cash generating, when you try to do fair value to determine discounted cash flow, you use entity specific assumption, you apply growth rate, you apply number of other estimates, the discount rates, etc. That is level 3. So when you look at the principle, so we've talked about again the valuation techniques. We've also talked about the quality of fair value, which is level 1, level 2, level 3. Level 1 is the highest good quality. Level 2 is all right. We are in okay zone. Level 3 is the gray zone, right? So you got to be very, very careful while you're looking at level 3 evidence, okay? But disclosures are important. And again, you look at company's financial statements and you will see those disclosures for level 1, level 2, and level 3. So when you look at fair value significance under Ind AS, where all it is being used, investment property, because you have to do fair value disclosures of investment property, employee share-based payment, apply this under IFRS 2, Black-Scholes pricing model. You got to disclose a lot of assumptions, leases. You got to again make disclosures of those discount rates and all. Revenue recognition, if there are multiple elements arrangement, you got to do revenue recognition, multiple performance obligation, allocate the performance obligation to each, allocate the contract consideration to each of the performance obligation, and that again based on certain fair value estimates. Then you have financial instrument, significant amount of use of fair value. Business combination, recognition, initial recognition, which is the acquisition method, is all based on fair value. Number of things which you need to do, some exceptions to fair value. Government grant, right? The accounting for government grant, you got to assess fair value. And then property, plant, and equipment, again initial recognition is fair value. If you applied a fair value accounting revaluation model, then again you got to disclose fair value and also account for fair value, right? Bunch of disclosures is what we need to make. Remember, this is not a measurement standard. This provides you guidance, right, of the measurement principles which needs to be applied in context of other standards. But there are a bunch of disclosures principles which are given here. If you are dealing with fair value, disclose information that helps user assess the following. What's the valuation techniques? What are the inputs used to develop those measurement, right? What are the unobservable inputs? So you got to look at valuation technique, inputs. What are the unobservable inputs? The effect of measurement on profit or loss or other comprehensive income. In fact, you're required to give a reconciliation, right? What's the opening value? What's the addition to that? What's the disposal? What's the impairment? What's the closing value? So all of that, right, they are required separately for each class of asset and liability. A lot of quantitative disclosures, right, are presented in a tabular format unless another format is more appropriate. So bunch of disclosures, lots of disclosures, right, which is required. Okay, so and then now we're going to have more questions, more and more questions. So I'm going to let my colleague Amit take you through this, okay, on your test your knowledge. Okay, so with this, we've come to an end of this session. But I think the important thing again for you to recap and remember is, what is fair value? Fair value is price which is received to sell an asset or paid to transfer a liability in an orderly transaction between marketplace participant at the measurement date, okay, which is also called exit price. Okay, and then we looked at bunch of other things within this definition, right? Within this definition, we looked at number of other stuff, which is, what is there a restriction on this asset, entity specific restriction or a security specific restriction or an asset specific restriction? If it is an entity specific restriction, I'm going to ignore that. If it is a security or asset specific restriction, that means it will travel to the new buyer or a new purchaser, then I'm going to consider that for determination of fair value. We talked about unit of account, at what level I'm going to fair value this, at the level at which it is likely to be transacted. We talked about is it quoted or is it unquoted? If it is unquoted, we're going to get guided by other relevant indices to determine fair value, right? We talked about principal market, most advantageous market. We talked about transaction cost. We talked about transportation cost. We talked about in use or in exchange, right? So, and then we talked about the valuation techniques. We talked about income approach, market approach, cost approach. We talked about the quality of disclosures, which is the valuation levels, right? Level 1, level 2, level 3. We also talked about offsetting risk in terms of counterparty risk. We talked about financial risk and non-financial risk, right? Whether it's a credit risk, currency risk, interest rate risk, the price risk. These are 4 types of financial risk, which, and again, you got to consider them for offsetting, if they meet the parameters which is out there. Number of stuff is what we talked about, but the most important stuff is that you got to apply this in practice. Look at number of example, look at how companies are disclosing. So this is a disclosure again, and the standard provides a lot of disclosure guidance, and standard provide a framework to measure fair value. Standard do not say that where is it you need to apply fair value. For where you need to apply fair value, you got to respective other Ind AS. Wherever they say apply fair value, you got to see that is there exclusion like inventories, right? Net realizable value, the concept of net realizable value is addressed in Ind AS 2, whereas for example in Ind AS 109, the fair value definition is same as what is definition of fair value given in Ind AS 113. So then you're going to look at the whole valuation measurement framework to determine fair value for, let's say, financial instruments in a way from that perspective. So with this, thank you very much, and please reach out to us for more questions, more conversation. Thank you very much.